Hi, I'm Alex, welcome to the channel and thanks for tuning in. So in today's video we're talking about GNOG, especially in relation to the results and what investors can expect from here. It's a quick update video today, but we're discussing a few dynamics which are important to keep in mind following the DraftKings deal and some market opportunities which are presenting themselves. Now before we get into it, please smash the like button. In our battle against clickbait on YouTube, when you do like the video, it's really helpful in letting the YouTube algorithm know that it doesn't only need to recommend the clickbaity, misleading videos. It's massively appreciated, helps out the channel a load, and so thank you so much. If you're new to the channel, then make sure you're subscribed. If you want to see more content, then check out the Patreon for the private Discord and live video calls, amongst other things. And as always, I'm not a financial advisor. This video is purely for educational and entertainment purposes only, but let's get straight into it. So on Monday, after hours, GNOG filed its Q2 earnings, which in summary were good. They filed revenues of just shy of $32 million for Q2, which is around a growth of 28% on the prior period. Now within the market, there did seem to be some negative focus within the market around the negative EBITDA and the negative EPS figures. Now firstly, it's really important to understand why this is the case. Clearly, if you're invested into a company and its EBITDA turns from double-digit positive millions to negative, then you do need to understand why that is the case. In the case of GNOG, this is all due to the costs associated with expanding into Michigan. Now before we dive into how this is going, I do think it would be interesting if they did file their results on an EBITDA basis, adjusted for the costs associated with expanding into Michigan. These are all one-off costs, and so they would be well within their rights to do so, and this would paint a much more positive picture and eliminate the market discussion on this topic altogether. So why haven't they done this? Well, primarily I think it's due to the fact that the market does not really look at valuation on an EBITDA basis, as you can see by some of the large players in the market, which are growing rapidly, DraftKings being a prime example. These are valued on a revenue multiple basis by the market, and as such, the key here within the market is driving revenue growth, capturing market share, and that is how to secure a premium valuation. As the market does mature, this will clearly focus towards driving profitability growth, but that's not the case yet, and the primary focus is on revenues. GNOG posting strong revenue growth is clearly a good outcome here. Also, it's good to see promising commentary in relation to Michigan, which was entirely in line with what we discussed and outlined in advance of the earnings being filed, so it's great news to see this confirmed. GNOG has also announced it has signed market access partnerships in Ohio and Arizona, increasing the presence of GNOG to approximately 33% of the US population, and that's across 14 different states. This is massive, and it's hugely helpful for the stock to grow and deliver on its strategy, and the performance in Michigan is clearly supportive and encouraging for the company ahead of its entry into markets like Virginia, West Virginia, and Pennsylvania later this year. While the results are good news, the main narrative for GNOG investors remains the acquisition by DraftKings. Now there are a couple of really important dynamics which are at play in the market currently. The first one is in relation to the relative pricing between GNOG and DraftKings. As an all-stock deal, we know that each share of GNOG will be in effect exchanged for 0.365 DraftKings shares. This deal has created an inextricable link between the stock prices of the two companies, provided that is that you don't believe the deal may fail to complete for whatever reason. Anyway, this dynamic means that GNOG's stock price should be the same as DraftKings multiplied by 0.365. For example, if DraftKings stock is trading at $55, GNOG should be trading at $20.08. That is the $55 multiplied by the 0.365 shares each GNOG stock is worth. If there is a difference between these two prices, then that in itself is an arbitrage opportunity. The movement between the two stock prices should be relative and the ratio consistent. Now the other dynamic that is more important is that of synergies. Now I have mentioned this in a video immediately after the deal, but this is hugely important and will be a significant driver of the future value of the combined business. A quick refresher on this is that in the DraftKings presentation, when the deal was first announced, they outlined a potential $300 million in additional EBITDA which could be generated from synergies, i.e. from combining the two businesses. As DraftKings is currently not generating EBITDA, we need to do a bit of maths here. Taking the EBITDA margin which GNOG generated during 2020 of 17%, which is admittedly probably a bit low, and calculating the implied EBITDA multiple for DraftKings, currently DraftKings is trading at 12.4 times on a sales multiple basis, so we divide that by the 17% margin, which gives us an EBITDA multiple valuation of around 73 times. Now, when you look at this $300 million of synergies multiplied by the 73 times valuation multiple on an EBITDA basis, the potential uplift to value from these synergies alone is $21.9 billion. This is enormous, basically the same as DraftKings' current market capitalization. Let that sink in for a second. Clearly there are a number of flaws with this argument. The first is that these synergies are from a sales document. This is clearly a best case scenario, and also they're outlined at being delivered at maturity. There's no timeline associated with this, and so that makes it a little less tangible. The other flaw is that the longer these take to be recognised and delivered, the less they're valued at. So while they're valued at a 73 times multiple on today's basis, that's not true if they're delivered over 5 years. It would be a lower valuation multiple. All that being said though, delivering just 10% of these synergies, which would not be earth-shatteringly difficult, would have a massive tangible impact on the valuation of the combined businesses, making it a highly accretive deal and a sensible one strategically for all investors. From here, it's a wait and see game, waiting to see how long it takes for the market to appreciate the deal fully and to understand the potential from a combination. Anyway, thank you so much for watching. I hope you enjoyed the video. If you did, please smash the like button. If you're new to the channel, then make sure you're subscribed. Check out the Patreon group for more information and exclusive content. And as always, please let me know your thoughts and comments in the comment section below. I find it so interesting to hear all the different opinions and perspectives, so please get involved. Thanks again for watching, and I'll see you in another video.